Well, hi there folks, it's Matt Hayson here reporting on a very important week for the economy and of course the property market. As we all know, the cash rate during the week was lifted to 4.1%. That's the 12th increase we've experienced since May last year. Now, economists have all these fancy words that they use, but one of the key ones is inflation remains sticky, sitting at 6.8%. And as we all know, the target band for the RBA is sitting within 2 to 3% within a reasonable time frame. And as a result, the RBA commentary is suggesting that further tightening may be required. Now, pressure is mounting on Treasurer Jim Chalmers as rates are expected to go higher and remain that way for longer. Some are suggesting that the cash rate could move to 4.6%. Morgan Stanley, though, they view that there will be just one more cash rate increase, sitting at 4.3%. But Goldman Sachs and Capital Economics believe that the terminal cash rate will be as high as 4.85%. However, as we all know, the RBA has their faux pas with market predictions, and so do all of these financial institutions who are guilty of repeatedly getting their forecasting highly inaccurate. Now, I'll take you back to this article, which was written on the 15th of February 2022. So not that long ago, and this was by the chief economist from the CBA, Gareth Aird, who are our nation's largest and most influential mortgage lender. Now, at that point in time, he believed that the cash rate lifting cycle would peak at 1.25%. Remember those days? We're currently now at 4.1%, and some are suggesting we could be as high as 4.85%. So take with a grain of salt some of these market predictions and forecasts from our institutions. Now, looking at the property sector, as we know, according to CoreLogic data, Sydney property prices, they were up 4.5% since the end of summer. But one of the big things that we've been told about is Australians have these big cash reserves and big cash buffers that they could fall upon and tap into to move through this higher rate cycle. But they are falling as well, down 3.7% at the end of the March quarter. That's the lowest level we've seen since 2008 and well below now the pre-COVID levels. Now, also we know that Westpac are fielding more hardship calls around mortgages as well, and those that have purchased a property, particularly high income earners, over the last 12 months are also starting to really feel the strain as this cash rate remains higher, and it's going to remain higher for longer. Now, as a result of that, Coolabah Capital's Christopher Joy, he believes that this latest interest rate increase is going to whack property prices again. And writing for SQM Research, Louis Christopher, in his boom and bust report, had 4 scenarios. He's now eliminated 3 of those, leaving one scenario, scenario number 3, which really does look like flatline growth for the remainder of this year, which could really remove this bullish price growth that we've experienced over the last several months. So while there's a lot of headlines about the impact that this cash rate may have on the property market, last weekend, for the first weekend of winter, we saw very good foot traffic at our open home inspections. Again, that's buoyed by this 15-year low in listing levels, and again, an auction clearance rate sitting at an 18-month high at just under 61%. We also saw 21 registered bidders for the auction sale at 72 Glassop Street in Balmain. And then last night at auction, we set a suburb record for 20 The Boulevard in Lewisham. So we'll be closely monitoring now the impact of not only this latest rate increase, but the conversation that rates could again go higher and the impact that that will have on market and consumer sentiment. So folks, that's what's going down in and around the property market. Thanks so much for watching, and I'll catch you all next week.